Okay.
Is it a different link for the broadcast, or is it the same one as before?
I'm guessing it will be different.
Is it a different link for the broadcast, or is it the same one as before?
I'm guessing it will be different. Okay, but it's working. I've just checked.
Okay.
Everything's working fine. I turn off the stream from my end, but obviously I can see what's happening live, which is fantastic. I just shared it. just shared the new link.
Brilliant.
So hopefully everyone will be able to join it with no issues. Okay. Probably give everyone like a couple of minutes for people to rejoin, whoever wants to join live, and then we'll just crack on.
Yeah. Totally sorry about that. Totally my fault.
Listen, it's okay. We all learn it. We all learn it right now. I was so confused for a second. I was like looking through settings. I was like, oh, am I doing something wrong here? There's no.
Yeah, I've never done this on YouTube before.
That makes me giggle to be fair. After we worked out, that was funny. That did crack me up. And can you just see my screen in terms of
Yeah, yeah. I can...
Awesome. We got there in the end. As I said, it's our first stream on YouTube, so we are learning. So that's the positive. Yeah, I shared the new link on X as well. So if you want to reshare that for your followers as well.
All right, brilliant.
All right. Well, listen. Let's start, and then obviously we'll save this video, share it, and then people can re-watch it later. And then from our next official first live stream, everything hopefully will go smoothly. And then, if anything, we can always have a play around with the settings and whatnot. How does that sound?
Beautiful.
Lovely. Well, listen, thank you everyone who's joining us on this first ever live stream. Obviously, we had a few hiccups out on the first couple of minutes, so we had to restart, and a new link has been sent to everyone. Hopefully, as I said, from next week, we're going to be back in full swing of things with hopefully everything working as it should. First of all, it's been an absolute pleasure joining the Market Intelligence TV brand with Imre. We've created it as a fun little project, talking about the market, discussing trends and patterns that are happening around the world each week. Hopefully, you'll learn something new. It is purely for educational and entertainment purposes only. Nothing discussed should be concerned as a financial investment of trading advice. Please do your own research and consult a qualified financial advisor before making any investment decisions. I have to put that right from the start, just so people don't get any wrong ideas about what we are doing with this little project. It's all for educational purposes. Hopefully, you'll learn along with us as well as we digest the market on a weekly basis. Well, very quick introduction from myself. My name is Matt. I've been a professional recruiter for just under a decade, worked within the private sector, started within agency recruitment, then moved into working for a venture capital business, and after that moved into the NASDAQ and New York Stock Exchange businesses after that. As I climbed up the ladder, I realized that it wasn't really my passion. And halfway through my recruitment career, I decided to divert into more research and data analytics, not just within recruitment, but also within trading as well. And here I am today speaking with someone who's got far more experience than me, not just as from a retail background, but also from professional background. It's Imre. So Imre, introduce yourself and tell us a little bit about yourself as well.
Yeah, thanks, Matt. Cheers. So thanks for the lovely tee up there on the introduction. So my name's Imre. I've been trading now. Technically, I placed my first trade in the summer of 2008, like peak financial crisis meltdown. But I didn't really pursue this professionally until several years later. But I've been doing this for well over a decade as a professional now. And my background in trading is largely on the institutional side as a result of that. I help run funds, both managed funds and proprietary funds in the past. Partners with a legendary currency trader named Andy Krieger, and we're still trading in business partners today. The focus for our strategies is largely global macro. So we're focused on global monetary flows, investment flows, capital flows, and trying to find the best vehicle to express our ideas as a result. No secret that the majority of that outperformance has been in North American equities over the last significant stretch. And consequently, that's where a lot of our attention has been focused as traders. But we've also been quite active in currency markets, a little bit in fixed income, and certainly quite active in commodities. So we have this kind of global 360 view of the market as a result. And yeah, that's kind of what prompted Matt and I to try this little experiment together, where we both have I would say more broad global view of the market than certain specialists who might focus on only trading one instrument or two instruments. Nothing wrong with that. It's just a slightly different approach.
Yeah, absolutely. Yeah, thank you so much for the introduction, Imre. Absolutely, much higher qualified experience than what I have. So hopefully, we'll be able to provide you two different perspectives, more from a retail side of not just trading, but understanding the markets, understanding what's happening around the world, and hopefully a little bit more from of a professional, more detailed view from Imre. Obviously, with every stream that we're going to have on a weekly basis, we are going to discuss what's really happened throughout the week in terms of the world and the markets, and as well as the economic numbers, as I think That's what drives the markets from a broader term perspective. And of course, it's always interesting to learn a little bit of trivia on the way. So let us, start off with the week. On Monday, we really didn't have anything special from the economic data, so to speak. We had plenty of speeches from the Fed, um, basically reiterating every single week that the policy is relatively restrictive. The rates may go down slightly over the course of the next 2 years. The terminal rate still stays the same at 3%. The only change of talks was around the job market and the job market as a whole in terms of the numbers and also in terms of the projections. Many of the Fed speakers have agreed that unfortunately the job market in particular, is not as strong as they expected, which means essentially they're planning to potentially do more rate cuts down the line than initially projected through the dot plot, as we had, FOMC a couple of weeks ago. Now, having that dot plot changed already, I strongly believe that dot plot will be changed again. On Monday, Imre, did you catch anything in particular that was of interest to you from any of the Fed speakers?
Not like anything, not anything that surprised me. I think other than the dot plot, the really interesting thing to keep an eye on is how the data is going to continue to shift and evolve. Now, I personally like to follow the market first and then look at the economics second. I think the one is a leading indicator for the other, not the other way around. But what's interesting to me with this labor market is that a lot of what's going on right now is what I would call self-imposed pain by U.S. domestic policy. So it's a very bizarre set of circumstances for the Fed to have to deal with as a result of that. Now, let's just keep in mind what is the Fed's current mandate, because there is some talks of that mandate being revised. But the current mandate is very simple. It's to keep employment stable or full and keep prices stable. That's effectively the dual mandate. So just note that that has nothing to do with boosting the stock market. It has nothing to do with keeping financial markets stable. I would say that is more of a byproduct of the Fed trying to fulfill its first two mandates. Now, just a little bit of history going back to '08 and the global financial crisis. The aftermath of the financial crisis resulted in this near global adoption by central banks of something called ZIRP, which stands for a zero interest rate policy. And in the time since the global financial crisis, the central banker has taken on this kind of mythological stature amongst macroeconomists. And there's this almost belief, I would say, that a central bank, if they're good and know what they're doing, can kind of engineer and the economy and the markets in a way to sidestep any potential recessions or hiccups. I think that's an absolute load of nonsense, as we're about to find out in the relatively short term. I say short term. I'm not talking weeks or even months, but just wanted to put that on the table so you understand what is at stake here. And my personal opinion for how this all ends extremely poorly is when everybody loses confidence in the Fed. I think that is going to be the nail in the coffin for this entire bull run. It's going to be a complete loss of faith in the Fed.
Yeah, I think I definitely agree. Some of the things that I've seen recently, especially with Lisa Cook and what's happening with her, as well as obviously, Donald Trump is pushing the agenda that, Fed needs to cut rates. The rates are way too high. And it's, in my opinion, is trying to do everything in order to either implement such a policy change whereby QE will be pushed extremely hard, or alternatively, the more funny approach, in my personal opinion, is start actually sacking the Fed members, which, as you mentioned, Imre, I think that's going to cause a massive loss of confidence in Fed, as essentially Fed is or was always known for the stability marker for the US economy, right? It was supposed to be this impartial governance body that controlled the monetary policy, and they in most of the time throughout the Fed had a dual mandate, right? Stability in the job market and inflation at or below 2% throughout the
Yeah,
years
and
there.
and here's a funny note on that 2%
Mm.
number. Why is the number 2%? Do you know?
No, actually, it was always mind blowing to me to why 2% was the target. From what I understood, it was the Bank of Japan's target, and then essentially the US implemented it themselves. But yeah, from a deeper perspective, yeah, give us a little bit of an insight.
It's a really silly story. It was an arbitrary number that a Fed governor came up with. I can't remember which one, and they just thought it sounded good. Like I'm serious. I wish there was more to it than that. But the 2% number is arbitrary, and what a lot of people don't understand is that inflation is and it compounds on an annual basis. Where I mean that's I think the best long-term way to track it. We're talking about price inflation here, so or prices rising to be technically correct. So what that means is if inflation is up 8%, for example, like huge jump, 8% this year, and then it falls to 2% next year. That's not good because that 8% doesn't just vanish. It doesn't like it's not like, oh, it was at 8 and now prices have gone back, to where they were before at 8%. No, we're now compounding inflation off of that crazy rise of 8%. That's why things have felt so out of control, since basically the end of the pandemic. For a lot of people in America, around the world, frankly, we had that surge of inflation in 2022 when the chickens started to come home to roost. And although inflation has quote unquote normalized and stabilized, even though it's still above target for the US, for example, the prices have remained elevated. I mean, I this is very anecdotal. I'm someone that travels a lot. I remember when, and look, grant me this, I do not have many vices, but when I travel, I'll be honest, I like to travel well. I remember staying at a five-star hotel, the best of the best,
Yeah.
a reasonable price, and this I know this might sound crazy, whatever. A reasonable price was around $1,000 a night. That is now the base for a lot of hotels that are not even the best of the best in major urban city centers. So when I think of that and the knock-on effects that has on every other part of travel, the price inflation to me is absolutely astounding. So for the Fed to be lowering rates here has me extremely concerned. Not necessarily about price stability, but of all the knock-on effects that's going to have. And I,
Yes.
I I think while the short-term impact may be seen as desirable for market speculators and investors, the long-term consequences are going to be devastating.
Yeah, I absolutely agree. And one of the most important data statistics that came out this week was actually really shocking, which was in regards to the monetary supply, which I'll discuss in a little bit more detail very shortly as we're going through the other statistics that came out on Tuesday for Europe. But yeah, it is extremely worrying. People don't seem to understand that even though the inflation is falling, the inflation is still positive. Therefore, yeah, it's a cumulative effect. And unfortunately, the wages are just not rising as fast as we had the inflation. So yeah, we are slowly on the precipice of. Well, I'm hoping it's not going to be any sort of a black swan effect that we had in 2008. But yeah, I think there's going to be a rise of inflation with the QE, followed by deflation and a massive recession. But yeah, as with anything, we're gonna have to see as more data comes out over the course, I'd say 3 to 6 months, and I think we're slowly but surely seeing the signs that this may happen. But yeah, from Fed on Monday wasn't too much of talks. Nothing that really popped out from my side. On Tuesday, the economic data for Europe was a mixed bag overall, as you can probably see on my screen that I'm sharing with you guys right now. France is still really struggling. It has been struggling for the last, I'd say, 12 months with the data that's been coming out. Manufacturing in France has been in recession for at least 20 or 22 months. Services you were holding for a very long time, to be fair, the 2022 to 2023 to about to mid 2024, the services sector was growing, but since then it's been in slow decline. What has been quite interesting is Germany on the services side has decided to bounce a little bit after, multiple months of slow contraction as well. But manufacturing is still getting hit quite hard. Again, German manufacturing has been in decline for I think 14 or 15 months now. The earnings that came out from Porsche and from the Volkswagen Group both missed estimates, and multiple plants are being closed. So in terms of what Europe is seeing right now is not a great recession, because we're not seeing those numbers yet, but the economy has slowed down dramatically, and we can sort of see that through the inflation that's been released last week as well, where year over year and month over month were in line, which was about 2.2% in most of the European countries. So um, yeah, the only outlying factor is obviously the UK, in my opinion. Obviously on Tuesday, the composite and services are still holding in expansionary side. Anything over 50 on the score, it means that the economy is expanding. Obviously, slower than expected, but still decent in terms of numbers. Unfortunately, the manufacturing is again been in contraction now for way over a year, and it looks like it's not going to slow down. Inflation in the UK is probably what's the most worrying. I think it's around 3.8% that I saw, with core I think reaching just shy of 4% as well. Bank of England has basically a stagnating economy and rising inflation at a rapid rate, which unfortunately means that they won't be able to cut down rates. And unlike the US, where you have fixed rate mortgages and fixed rate loans, in the UK, everything is fixed for 2 to 5 years, depending on what sort of deal you get. But after that, it's based on the interest rates, which, yeah, obviously sit in the UK really, really hard, especially when it comes to food inflation. I saw the markets. I think it was 6.5% last month, which year over year, that was the goal. So yeah, I'm seeing massive changes from the UK perspective. Hopefully, that trend doesn't translate into the US and other markets, and it won't be as affected, in terms of the food prices and energy prices are keep rising in the UK market. I mean, for yourself, Imre, have you got any sort of pointers on the European market side? Have you heard anything else?
No, I think you've covered that really well. Yeah, I don't really have too much to add here. I think what's interesting from a trading perspective, and we can potentially get into this when we take a look at some technical charts, but the DAX has been after an incredible run, really, for since what the beginning of April. We've had this fairly tight range now for several weeks. So it's going to be interesting to see how the energy from that range is going to be resolved. But yeah, in terms of the data, I think you covered that beautifully.
Good stuff. Good stuff. Oh, and obviously the US very, very quickly in line. Slow expansion both on manufacturing and services. Nothing to report on that, to be fair. Um, the only thing was obviously the Fed should power speech later on. Again, it's sort of the really copying each other's words. Essentially, they have to stay as a unison when it comes to how they're portraying themselves, both from their opinions, as well as obviously the state of the economy. There are a few outliers, which I believe Imre could give us a little bit more of an insight, but there are two Fed members that tend to be a little bit in disagreement with Powell for potential reasons of taking his spot as the Fed chair next year. What do you think, Imre? Is that going to be their plan? The two that I'm talking about is, I believe it's Waller and who was the other? Um, Waller and Bauman, I believe.
Yeah, I have no idea who the administration is going to appoint next, but whoever it is, it's going to be a complete yes man, for the Trump administration, which should be
Yeah.
concerning because there is that I've long been skeptical of how independent the Federal Reserve is of the government anyway, but I mean this would not be hiding it at all, right? So whoever the
No.
next appointee is going to be, and I'm pretty confident they'll be rubber stamped and confirmed as the nominee. It's gonna be a de facto extension of the administration's policies.
Yes, I agree. Now, I think at that point, we are going to see. I mean, even Hassett, threw his hat into the ring, which, I mean, people have various opinions of him. I believe, unfortunately, he's not the right person for the job, and that's me putting it lightly. I think there are other more suitable candidates, and in my opinion, Fed, even though, yes, I agree with you, Imre, does the Fed have its independence? No. In my opinion, we saw it with the Biden era and what they've done to the economy in terms of releasing trillions upon trillions of dollars into the market. Um, you know, I think the independence of Fed is truly over, especially next year with Trump being involved. He likes to have yes men everywhere, and I believe that the Fed will follow suit, and we may see damage being caused. Q Q3 Q4 2026, once this person's in power and start influencing the other Fed members. But yeah, on Wednesday, we didn't really have anything. Again, Germany is really struggling from an IFO perspective, but the climate current assessment and expectations are at I think 2 or 3 year lows, I believe now. Yeah, the German market has been struggling. The main sort of push that they've had was from the defensive perspective with Rheinmetall and obviously producing a lot of defense equipment for Ukraine. With the Ukraine and Russia situation being shaky, Rheinmetall did take a bit of a hit in terms of their stock in general. Now it's been picking up because of Trump potentially allowing Ukraine to have Tomahawk missiles and more defensive capabilities. So I believe from that perspective, Germany will have a little bit of a pickup from the manufacturing side. But in terms of the consumer side, manufacturing cars, especially luxury cars, it's been an absolute mess, and unfortunately, pretty much all the car businesses in Germany have taken a hit for myriad of reasons, through the fear of tariffs, all the way to consumer spending in Europe is weakening at a relatively quick rate, and with one of the first things to go is luxury items such as nice cars, right? Which we are slowly seeing, and both from car registrations and obviously car prices as well. They are falling relatively quickly in Europe, so we are going to see a little bit of a shift in terms of how those companies will be able to mitigate a little bit of the downturn, maybe through innovation or through dropping prices and hopefully increasing the volumes of sales in that way, and unfortunately decreasing the margins ever so slightly. But from your perspective, have you got anything to add from the IFO that's been released on Wednesday?
No, again, I think you hit the nail right on the head. It'll be consumer spending is something that I look at very closely because it tells you a lot about the underlying psychology of the market. Because guess who is invested in the market? It's the same people that consume items, right? Discretionary consumer goods. Right? So
Yeah,
it's the same group of people. So having an insight into their behavior is very revealing.
correct. Yeah, and then a little bit from Japan, BOJ's monetary policy meeting minutes. I mean, I haven't got really much to add from the previous spaces that we've had. Ultra loose monetary policy, and that's where it's heading. There were some rumors that they were going to hike interest rates to 1.5%, and that's been debunked, I think, twice already by the current BOJ members. The term that they like to use, and I think is pretty much a broken record at this point, is the word uncertainty, the word loose monetary policy, and the economy is growing at a steady pace, or recovering at a steady pace, shall I say. They've been using the same language for the past 2 years. Nothing's been changing. The only thing that's going to move yen is genuine actions. The words from any of the BOJ members, it's just not doing anything to the market, to the Japanese market in any perspective. Nikkei is basically in range in terms of the price for the last sort of 6 months. And I think the only thing that's scary for the Japanese market is the rising yields. A pretty dramatic effect. I think they're currently close to century highs, or they are at century highs, or they even
Yeah.
broken the century highs recently. Is that right, Imre?
Yes, I do believe that's right.
Yeah. So breaking century highs. The BOJ owns majority of its own debt anyway, so the only thing that they'll do is just keep on buying, their own debt until there's something happens. But the currency will just carry on being devalued unless there's a massive shift in the monetary stance, which I'm not seeing it. Are you seeing it, Imre, at all? Do you predict seeing it change anytime soon?
In many ways it's overdue. But
Yes.
the currency hasn't followed through, and it's had every reason to outperform this year. Um, the idea that here's the thing, right? Here's the very odd thing. There was once a time when, for example, the Aussie yen carry trade made a lot of sense, and
Yes.
you could make a lot of money just on the carry. The interest rate differential is not so great anymore that I think there's a lot of alpha to be picked up on a carry basis. Um, and that makes it really interesting in terms of how much lower the yen has to go. If I'm looking at for example, a chart of yen futures or a chart of dollar yen, yeah, we could see the yen, we should see the yen depreciate further. The real question for me is, how is it going to behave when another crisis hits? Will it be picked up as a safe haven, or will it continue to underperform? And will the Swiss franc take its place? Will something else take its place? Like, those are very interesting questions. But as far as trading the yen goes, I would not want to be long a tremendous amount of yen right now. But
Yeah.
I also wouldn't want to be short yen for expecting a huge move.
Yeah.
Um, that's something that I would struggle with a little bit. I see the yen broadly going sideways for a little bit longer. It's in a weakening stage right now, weakening cycle right now. I think it'll strengthen a little bit, and I think we'll go through a trading range for a little bit longer. Then I think we're going to get a sustained period of yen weakness, and then I'd be very, very cautious, about being short yen. So yeah, long story short, I do agree with you, but I'm looking around the corner, and I'm far more excited in the long term about being long yen than I am being
Mhm.
short yen. I think that is going to be the next currency trade that people will talk about for decades to come, is a surge in yen strength. Now,
Yeah.
I don't think that's anytime soon, right? But I think it is inevitable.
Yeah, yeah, yeah. Personally, I agree. I don't think it's going to happen in this decade, and that's just my personal opinion. I think maybe from 2030 onwards, we once the old guard at the BOJ leaves or passes away, and I think at that point we may see a large shift in monetary policy, and of course, with risk aversion, I'm really interested to see, if something else, breaks out, whether it's a war, whether it's a financial crash of any sort. Will people, go to yen as they used to over the course of a century, or as you've mentioned, will they pick Swiss franc, which I believe it's a much safer option, especially with how the Swiss banks have nullified the rise of inflation that other countries had. They didn't print anywhere near as much money into the supply, and they didn't have to because of the gold reserves and because of the overall stability of the market, where the unemployment was extremely low, and the currency was already relatively strong as well. So yeah, but at the same token, Switzerland in general have their own little problems in terms of just overall growth. As a country, both from GDP per capita perspective, but also from a population expectations, and the population downturn that they're having overall. As a and Japan has the same problem, to be fair, as well. So we're going to have to see how Swiss franc handles that part of the problem that they have with the economy, which obviously brings me on to Thursday. We didn't really have too many data from the European side. We had S&P interest rate decision. Came as the consensus 0%. They don't really have inflation. In some months they had actually deflation. So right now they don't really need to. They don't really need to do anything with interest rate, which is, in my opinion, the perfect place to be. They can more focus on now how to to stimulate the economy through other means. Hopefully not by decreasing interest rates any lower and putting themselves in the BOJ situation, but yeah, I think they are probably the most stable market out there right now. I mean, what do you think on Switzerland overall, Imre?
I think Switzerland's in a very tricky position. Um, I just wonder what is going to drive their economy.
Yeah,
I mean, the export of luxury goods, that is not something I would be confident about hanging my hat on if I was the Swiss. Uh, what else is there? Chocolate, financial services.
yeah,
It's concerning. It is concerning. Demographically, the Swiss have a little bit of a problem as well. Now, does any of that mean that the Swiss or the Swiss currency is at risk of significant decline? No, but I also don't see the Swiss franc really backing off too much in terms of strength, right? And that's not the best news for the Swiss. There's a reason that the Swiss have been desperately trying to keep their currency at bay for a very long time, and that led in the first Trump administration for Trump to call them out on being currency manipulators, included the Swiss in the same breath as China, which was
yes,
astounding to me.
yes,
So I think Switzerland has a lot of structural problems, and I don't see a good way out for them. That being said,
yes,
I could say the same thing about Germany. I could say the same thing about China. I could say
yes,
the same thing about many other countries in the world. So Switzerland are
yeah,
not unique in that regard.
absolutely. I always put all currencies into the one rotten basket, essentially. But I believe, from a currency perspective, Swiss franc is the best out of the bunch so far. From obviously the major currencies, Brian. We're not talking about the emerging markets, but the major currencies. I believe the Swiss franc is the best out of the bunch. I mean, in your opinion, have you got the best out of the bunch? Is it Swiss franc as well, or is it a different currency?
Well, it very much depends on how we want to define best. If we're talking
Yeah,
pure
sure.
performance, then yes.
Yes. Yeah, pure performance. Yes, compared to other currencies.
Yeah. Yep.
Uh,
The interesting thing with currencies, right, that people have to understand is that a lot of this from a macro basis, almost all of it has to do with the dollar
yes.
and the dollar's status as the de facto reserve currency of the world. And what the Americans don't seem to understand or have a very short memory of And if it sounds like I'm bashing on the Americans a lot today, I'm not saying that they're completely oblivious to the reality of what's going on, but I do think this administration has a very short memory in terms of history and in terms of why the dollar is the reserve currency of the world to begin with. And a lot of that has to do with the aftermath of the Second World War and how the US was really the only industrial powerhouse that was left unscathed. And that
Yes.
allowed them to be the financiers for Europe and de facto the rest of the world. And that probably came with an explicit agreement, if at least behind closed doors, but publicly facing, the implicit agreement was that the dollar would be the reserve currency of the world, meaning all trade is priced in dollars. And in return for that, the US would lend a very active and helping hand to its allies in terms of securing their economic and military futures. This has been a win-win for the entire world. And when I'm talking about the world, I'm really talking about a West-centric
Yeah.
perspective and Western allies. Uh, so when you look at NATO and the UN and some of the administration's rightful grievances of countries not meeting defense spending budgets and things of that nature, sure. But why is that the case? It's because the outcome has been excellent for the United States. The military benefit for the US cannot be overstated. It's been tremendous. And a lot of people that don't understand actual, geopolitical strategy and military strategy fail to understand that the power of the US is from a military standpoint, taking nukes off the table, is twofold. One, it's aircraft carriers. The US has the strongest navy in the world, and a large part of that has to do with its significant number of aircraft carriers, which are de facto mobile staging bases that can be deployed literally around the world. The other reason is for military strength and supremacy on the part of the US is the fact that it has this network of allies where they can also stage troops around the world. The issue and limitation with aircraft carriers is that they're expensive to maintain and very expensive to continuously use as a deployment base. But if you have an allied country, and a lot of people, not to get extremely political on the subject, but what is the reason that the US has supported Israel so strongly? A lot of it has to do with simple geopolitics.
Yep.
Israel is de facto a staging area for US intelligence. Now, the US will not put troops in Israel or anything like that, but they don't have to. They have this system of allies and that they where they can literally place troops, whether we're talking about Europe or have deep intelligence assets and networks. And that's the geopolitical side. How this relates back to the reserve currency is that when you have the reserve currency of the world, you have you're going to have this continuous need to continue debasing the currency, which is what the US has been doing. And ironically, that undermines the reserve status of the currency. So it's kind of this perpetual feedback loop that eventually is going to break. The question, of course, is when? Is it going to break in our lifetimes, Matt? I don't know. I
Yeah.
genuinely don't know. I don't see it breaking anytime soon.
No.
Within our lifetimes is possible, I suppose. But there is in the modern world of monetary policy, there is no such thing as a reserve currency that can stand forever.
Correct. Yes. I mean, yeah, we've had the German mark fall. We've had multiple currencies throughout centuries essentially have fallen. Right. It's just part of nature, and part of civilizations. To be fair, at some points that financial system gets maybe not reinvented, but reborn in another factor, right? When we had the McKinley Act in 1900s when it was introduced, where the paper dollar was essentially bound to gold, right? So you can get your notes and you can go directly to the to the government and exchange your notes for gold and vice versa. At that point, after the war, essentially, as you mentioned, the US became sort of the last unscathed bastion, really, from the World War II. A lot of people were obviously moving their the gold and the silver to the US, and essentially, apart from Switzerland, of course, Switzerland was again another country that was taking in tons and tons of gold and silver, but because of the pegging of dollar to gold, essentially the US was able to control the globe essentially, not just through trade, but through the monetary cycle and the monetary policy, which unfortunately, after an idiot decided to depeg it in 1970. 1978. I can't remember. It was in the 60s or 70s where the gold standard was taken away from the US. That's where we saw a dramatic rise of inflation, insane, uncontrollable spending, and a paper currency that's worth whatever the government tells us it's worth. And as you mentioned, and as we are seeing right now across the globe, there is a massive distaste for the US hegemony. It's happening right now. We're seeing it in our own eyes. Questioning the US allies, and the wars that's been happening in the Middle East, the sanctions on Russia, and the tariff wars that Trump is essentially pushing onto the globe. All of that is essentially breaking the dollar as the reserve currency, because countries are thinking, well, if I am going to trade in dollars, and for some reason I'm going to make the next or the Trump administration unhappy, or the next administration unhappy, they might sanction us, that they might cause our country to go bankrupt, or hemorrhage our growth, etc. So countries are looking for alternative ways of able to control their own economy. And one of the key things that we've seen over the last year, especially this year, is gold. Um, it's been on a run I haven't seen in decades through back tested. And I believe that kind of purchase of gold through COMEX, and probably the only way you should source your gold prices really is through how COMEX is controlling the prices. A lot of the buying has been via China, and I believe they are preparing themselves for the inevitable crash of the dollar. As you, Imre, mentioned, whether it's going to be in our lifetime, maybe not, unless there is there's World War III that will actually happen, or something else that will completely destabilize the market. Maybe there's going to be a massive cyber warfare between China and the US, or Russia and the US, or whoever else is interested in taking a piece of the hegemony pie. Yeah, there are a lot of factors that are taking place, but the charts and the prices are not lying, and what we're seeing right now is potentially the very start of the current financial system change. I wouldn't call it necessarily crisis, but I think change that was very muchly needed. Yeah, is there anything that you would like to add from that perspective, Imre, at all?
No, I think you nailed it.
Good, good. Glad we agree. Well, listen. In terms of Thursday, the charts that we had, the data, all of it came up positive, which is very good to see from the US market. The only caveat I had when I did a little bit of a digging in terms of the durable goods orders, it's mainly through the NATO spending of purchasing, missiles from the US, aircrafts, so on and so forth. That has increased a lot over the last couple of months, as Trump essentially announced that, hey, we're not directly selling weapons to Ukraine, we're selling it to NATO, but we control the NATO, but then we're giving NATO all the control to provide weapons to the Ukraine. It's all a massive mess, and a political waffling, as I like to call it, essentially, whereby no one's really taking accountability for the actions. It's just, oh, this party's doing it because of X. Oh, well, actually, this party's doing it because of Y. But really, we all know who's controlling the weapons manufacturing and redisposition to other countries. It is the US. It spends the most at NATO. It has the biggest the biggest army in NATO. Essentially they are controlling the NATO's both budget and spending, and redistribution of ammunition and other military defense and offense mechanisms. So yeah, that's essentially where those durable goods orders have been so strong. And second of all is obviously the tariff, not easing necessarily, but Trump likes to go essentially at 120%, and then through negotiation, through scare tactics, he gets to the numbers that he wants in terms of the tariff controls and the prices. And I think after everyone saw the April and essentially what people called the big bluff, markets have stabilized a little bit. So that's where the goods orders have increased a little bit, and again through GDP. I'll go into a little bit in a little bit more detail, but yeah, the GDP isn't as strong as the numbers claim. 3.8%. When you go deeper into the reasons why it's at 3.8%, I'll let you know, and obviously we can jump into it. Again, initial jobless claims a little bit better than expected. PCE came out a little bit higher than expected. The personal consumption expenditure prices 2.1%. Nothing to really see here. Yeah, have you got any comments on the data?
No, not really. Again, I think you did a great job breaking that down. I didn't even go into as much detail there as you did, to be honest. I
I
think
was
that's
just
great.
I was just interested. I was like, well, these numbers are really high for some, 0.5% on GDP, better than expected. You don't really see that too often from the historical data. So I was just
Yeah.
curious to see why GDP annualized has grown so dramatically. And yeah, when you dig into it, it all makes sense. um, another another Ponzi, in my opinion, in terms of the data provided. But hey ho, who am I? I'm just a random guy on the internet, right? And then yeah, Fed's peak, nothing new, same talks. And then Friday, what did we have that was really interesting? Yeah, the PC expenditures price index year over year, month over month, both as expected. The month over month for previous was revised down by 0.1%. Again, nothing to really comment on any of this. The only thing that was interesting is both the spending has risen and the income. Um, it's relatively, especially the spending, personal spending is it's relatively high for the particular month that it was collected. Same for income, but the income is rising at a slower rate than spending, which again sort of ties to the fact that the economy is slowing down, but the prices are high, right? So people have to spend more for consumables, miscellaneous food, and energy, so on and so forth. Usually what you do want to see in a great economy is personal income rising, and personal spending decreasing or being lower than income, because that means multiple reasons, right? From personal spending, it means that if you spend less, you tend to save more. You save more because you don't need to spend as much because the prices are lower and the economy's doing better, both from an inflation perspective and from the growth perspective as well. Um, so yeah, usually you want to see the reverse if the economy is doing great. Am I hitting the right there? Am I hitting the mark, Imre? Or
Absolutely. Yep.
good. So then yeah, and then finally Michigan consumer sentiment. I've got an opinion on it. I've seen on X being reported, and then when you go into the detail, the the diversity of data collected and how it's collected, it kind of reminds me of the BLS, NFP data collection and the birth death model of how many jobs were created. Very, very silly. You have two political parties. Democrats are saying the inflation is going to be at 4.7%. Republicans are saying it's going to be 1.2%, and then you have the independents, which are probably the smarter out of the bunch, where they probably see the inflation being within 12 months at around that 3% mark. But again, I've looked into the data a little bit more, and I'm not seeing how many people were surveyed to collect that data. It's yeah, I wouldn't take into consideration at all. I mean, from your perspective, Imre, what do you think on the UOM data?
You know, it's actually not something that I spent too much time digging into beyond the surface number.
Yeah,
Um, I don't really have too much to add there. I think the
fair enough.
action in the markets
Yeah,
backs that up perfectly
yeah.
well. Like there's a very clear logical link there.
Yeah, no, I agree. Yeah, the market didn't react to those numbers at all. They don't care that the expectation index is at, the 2 year lows or 3 years lows, I believe. No one really cared. Um, and then yeah, nothing else on Friday was released. So yeah, that's economic data. Now we'll go into charts a little bit in a little bit more detail. I'll leave it to Imre to talk about the S&P first, as that's his main vice in the market, I'd say. Would you agree?
Yeah, I mean, if we're talking about capital markets and equity markets, the S&P 500 is unquestionably the most important in the world. So yeah, that is the market that I look at the most often for sure. Now, in terms of what I see happening like this, and Matt, you and I have talked about this a little bit, just maybe not with the S&P specifically, but with the Nasdaq in terms of, hey, looks like it's reversing, looks like it's reversing. Absolutely yes. And the sign of a strong market is when it's you see responsive buyers stepping in very quickly, and saying, you know what, yeah, this is cheap enough for us to start buying again. And you're like, well, hang on, the market hasn't even dropped all that much. So not surprised at all by the end of the week here and how the market has rebounded strongly. It's kind of funny. I mean, I'm looking at this past week, and
Mm,
ooh, since Monday we've dropped like peak to trough in the futures like less than 2%,
yeah.
and people were already talking of as if the world was gonna fall down, or like the ceiling was crashing down, and I mean, that tells you something about how frothy this market is,
Yeah.
and that's concerning. Now, I think if we get, yeah, I think for me the key level is last Wednesday's low. If we break below there, then I do think we'll see a larger rotation in value. So that would be the low from the 17th. That
Yeah.
is a strong low from a technical perspective.
Yeah, you're seeing it right now. I've just jumped into the 30-minute chart here on the US 500, and yeah, just on the 2% decline, 1.93%, and yeah, I saw, absolute panic everywhere that the world's falling apart. But if you zoom out, the market hasn't basically done anything for the last week really. It's back to the similar levels where it was when it closed on Friday, right? So from that perspective, you look at the insane run that the S&P had ever since April. If we look at the 4 hour chart here, and here it is, the sort of the August level where it dropped 200 points. You then zoom out again, and it's just following the same path, really. You can see the trend is weakening, over the course of, probably I'd say, since sort of 12th, 13th of August. You can see that the rise hasn't been as pronounced as you had it, back when you had the tariff scare, right, in April. You had that amazing double bottom from a structure perspective, and then it just skyrocketed, thanks to Trump saying, you need to buy the stock market, and essentially, egging everyone on to buy. And I believe that there was some shady tactics that happened. Looking at the level two data at the time, I was seeing the transactions popping up, and the amount of shares being bought, and I just couldn't believe it. The volume was absolutely astronomical. We were seeing, based on the Trump tweet, we had a 500-point move on the NQ up or down within an hour. which we haven't seen in a very long while. Now, the market is stabilized now, wherever Trump's saying on X. It's whatever. It moves 50 points, 60 points, it goes straight back up. It doesn't really care what Trump has to say. I think, there has to be some insane catalyst right now for the market to either have that correction, back towards that, 6.2, 6.3 mark. Otherwise, it's, going to continue either to range right now where we are, which is probably the more plausible scenario for the S&P, or it will just continue to go up to that 7,000 mark, as many of the banks are calling for the end of the year to reach that high. Do you think 7,000 is doable for this market for the end of the year?
That's a good question. I think that's a slightly optimistic target, to be honest with you.
Yeah.
I personally, not that I'm gonna take a bet on this one way or the other, but I would be a little bit shocked if we hit 7,000 by the end of the year. My personal view is that we will make another new all-time high. It's probably not going to take all that long, and we have scope to continue into the 800s. But I would venture before we reach 6,900 that we're going to get a more significant pullback. Likely back to somewhere where we are trading right around now, to be frank.
Yeah.
So, I don't know that 7,000 is impossible to reach. I wouldn't want to bet against it,
Yeah.
but I think that's a tall order just based on the math that I've done. Now, here's the thing: is that if you think about good news that could continue coming out,
Yeah.
that is an interesting thing to kind of consider, right? What more good news could there possibly be?
Yeah.
What
Yeah.
what the market was waiting for was, all right, when is the Fed going to cut again? And how are they going to cut? And why are they going to be cutting? Now we have those answers. It's basically they're sacrificing the labor market here, right?
Yes.
And people are thinking that, well, if you cut rates, you spur growth, that's going to spur hiring, labor market's going to bounce right back. No big deal. Sure, we might get a little bit of a rise in inflation, but it's going to be manageable. That's very much the attitude that we're seeing right now. So what more good news can come out? I genuinely don't know. I really don't know. Is
Yeah.
it going to be massive earning beats? Is it going to be, instead of the Fed cutting 25 basis points, they'll cut 50, which I think would be really bad news, actually, if they cut
Yes.
50 at the next one. I think that would actually be very distressing. But,
Yes.
so my point is that I think all the good news has come out, and that usually tends to happen at the later stages, of a cycle. So I think the potential for downside surprises is far greater than the potential for upside surprises. So that's got me feeling a little bit more cautious as we're heading into the end of year. Not cautious enough to become an outright bear, but I am trimming how strong of an upside position that we're taking now.
Yes. Yeah, I agree. From the P&E perspective as a whole, the market is 26, 27x, potentially even higher right now. Which usually where you want to see the healthy pullback to is around the 24, 23 to 24x Ps ideally. That's where the market should be. So from that perspective alone, it's definitely an overbought. But what I like to do sometimes from a fib retracement perspective is I like to see the recent pullback that we've had, and yeah, the levels that you've called 60, 69, 13 is, or the 6,900 is potentially doable by the end of the year, and that's where potentially we'll see a much larger pullback. What do you think? Is it going to be a pullback from a perspective that people just want to cash out before the end of the year and just close off their books and move, essentially rebalance their portfolios into buying some heavily reduced prices stocks? Or is it going to be maybe something will come out that will trigger the market to sell at that level?
So I mean, my attitude towards that is like, I don't know and I don't care. And the reason I
I
say
like
that
it.
is because the only reason people sell stocks is because they think they're selling them at a level where it's unlikely, the chances of them realizing further gains is less than the chances of them protecting their downside.
Yeah,
That's the only reason. The only reason you would take profits is because you're thinking, I think the odds are starting to shift. It could keep running, but it's gone far enough that I'm sufficiently worried. It's the only reason anyone trims exposure, whether they end up being right or wrong. Now, the interesting thing, and here's just my opinion. I don't think this market is going to top on bad news. I don't think we're going to get a bearish catalyst that's going to mark the very top. We're going to top, sell off, and then the bearish catalyst will come, and people will retroactively point to the catalyst as the reason that the market sold off. My favorite recent example of this is COVID. If you look at the COVID crash of 2020, the market didn't top as the COVID news got really bad. It didn't top because of COVID. COVID was just the accelerant. The market
nice.
topped before the pandemic stuff got really out of hand. Okay,
Mm,
so but people call it the COVID crash. Technically, it
yes.
wasn't. The market topped before COVID became part of the mainstream. So, and that is the same for every single major financial um, or end to every cyclical bull market. Bull markets
Yeah.
never end on bad news,
Yes.
and bear markets never end on good news.
Yes.
So,
Yeah.
every time we get a local top, the thing that I'm looking for is based on the nature of the decline, what kind of catalyst is going to come next? And right
Yeah.
now, what's interesting is that the catalysts for downside surprises are varied and they are many.
Yeah.
There are many. So I think it would be foolish to ignore the possibility for a black swan as we head into the end of the year, but um, my worries are more, I would say, towards the middle of next year.
Yeah. 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 You could do some good points here,
And
and
I
yeah,
do not have a crystal ball. Okay? I don't know anything that you don't know. This
yes.
is just purely based on math. It's purely based on
Yes.
historical cycle work. It's all math
Yes.
based.
Correct. And you look at the historical data, right? We're literally seeing right now what we had in sort of, the prior to the crash in the 2019, where you had a market where you essentially you dollar cost average, and you just close your eyes and essentially the market will just keep going up, right? There's that steady, and we're looking at the weekly chart here. We've just seen steady growth over each week, and then essentially that's where the big drop essentially happened, right? Um, and do you dollar cost average, here or here or here? No. Essentially what you're looking for from a no not just in maths perspective, but also through the historical parts. You're looking at previous rebounds and showing any sign of stability before you go into, okay, well, I'm going to go start dollar cost averaging around here, 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 and then just seeing where the market takes us, right? And again, same situation. We had that massive drop, we had that rebound, and then we had that a little bit of structure on the market, and then hey, we had that growth again, and we're sort of seeing it right now again. And essentially, bang, another very same situation where the market was sort of growing steadily, steadily. Yeah, it had a couple of pullbacks, but essentially, there was nothing major that was happening. It was always creating high lows when it was going up, and then we'll have that initial sort of, so to speak, crash through the tariffs, right? But again, prior to the tariffs, you saw the market's exhaustion, because essentially it was going up, going up, going up, and essentially it was creating a plateau or a Wyckoff situation whereby it started going into a range for multiple weeks, and then we had essentially a break out of that structure. Very, very little. I mean, probably what, 30 points here. We had that little break of a structure. Probably got more buyers in because everyone's thinking, oh my gosh, we're going to have another bull run now that we had multiple weeks of consolidation. And hey ho, nope.
Mm-hmm.
We had another crash, and we're potentially seeing it here as well. That kind of run that we had December, October time is essentially what's happening right now, right here. So yeah, as you
Yep.
mentioned, potentially. decent levels to start taking some positions off, especially if you're, a perma bull. So yeah, from my perspective, have you got anything to add on the S&P, Imre, at all?
No, not really. I mean, I trade the S&P from both a short-term perspective and a longer-term perspective, and I think having the ability to do that is really helpful because I don't feel pressure to have to act uh, one way or the other. But I will say that I really like the short-term action right now. I think it's a trader's paradise, right? So it's definitely, if you are a day trader, this is the time where you should be doing very well because the moves have been very clean, and they've been relatively simple and straightforward as well. Just be patient, pick your spots. Um, when I say it's easy to make money in this market, like I'm not I'm not saying trading's easy, but on a relative basis, September has been one of the easier months to trade, in my opinion. It's just been a very clean market to trade. Now, that doesn't mean you have to take a trade every day, but it does mean that you should be very judicious about picking your spots. But there are opportunities that are popping up very frequently, in my opinion.
Gotcha. So, I mean, from a shorter perspective, have you got any particular levels that, people should potentially watch out for?
I mean, I haven't finished my map yet for the start of the week, but as soon as I have that done, it'll be on my Twitter, on my X.
Yeah, yeah, they're definitely something to follow Imre if you haven't. He has some insanely good auction maps and yeah, some really really good perspectives, both from short term and long term. Even if they're not signals, and again, all of it is for educational purposes only. But you'll be able to see, the from an institutional perspective where there are buyers, where there are sellers, and what's really happening on the market, rather than just seeing, you know, green and in my case black candles. um, that's definitely it. I mean, from my perspective, I always like to look at Nasdaq is one of the key things, or one of the key indices I always look at from an analysis point of view, and also more from a risky health market point of view as well. We saw similar action that we saw on the S&P. I mean, the Nasdaq has dropped a little bit lower than the S&P, about 2.3% on the decline. But listen, from the NQ perspective, earnings are absolutely doing extremely well. All the companies are, Oracle has done insane numbers, both from growth perspective, but also market cap perspective. Nvidia is doing phenomenally well. Obviously, the question is in regards to China and the H20 chips, whether they're going to be banned or not, and if they are not going to be banned, to what degree will Nvidia will be able to sell to that market. If not, they'll probably do it through third party countries like Singapore and Indonesia, or essentially, Singapore and Indonesia they'll buy excess amount of stock. They don't need 80% of it, and then what they'll do, they'll resell at higher prices to countries where the US isn't selling as much, or there are trade wars going on, such as China. It's been happening for decades. Every time the trade war happens, you see a spike in other countries, especially through international transit. Unless Imre, any of the countries that are usually used.
It's a good question. That's honestly not so much my area of expertise.
Yeah,
But from what you're telling me anecdotally, I would say that's right.
yeah, fair enough. But yeah, from a technical point of view, again, you zoom on the market is still bullish. I mean, overall, what you see on the short term, especially since last week, it's at similar prices. So potentially we're going to see a much of a larger range. Given the fact that Nasdaq is the riskier the indices, Obviously, for those who don't know, Nasdaq 100 has just 100 tech companies, whereas the S&P 500 it encapsulates both the Nasdaq, the Dow, and obviously other businesses. You know, the other 400, 370 businesses. So it's a lot less volatile when it comes to price movements, whereas obviously NQ and Dow tend to be the bigger movers. So I can expect that range to not break. I mean, if anything, we might see a bit of a small consolidation over the next month or so before we usually get that end of the year Santa rally and potentially that 25,000 mark hit before further sell off back to, I'll probably say around those areas where you can see 2400, 23,500 right here as well. And that could be potentially the points where if it does decide to sell, that's where we'll see that retracement for sure. And then finally, from my perspective, I would like to talk about gold as well. Um, I absolutely love gold. I've been looking at gold for multiple years now, ever since COVID and what's been happening around the world. Yeah, pretty much parabolic move since August really. Had a few stops on the way. I think the 3600 was a good marker where I decided to start, built a bit of a range, thought it was going to be a Wyckoff, and we were going to see further sales. And what Wyckoff distribution usually is where you have a period of consolidation on the market. There's a narrowing range, and then there's a breakout, and then either with the Wyckoff it usually drops lower and drops below this range here, or you have a break higher and then break back into range and then it ranges again, which it did. But then, yeah, we had this massive spike to that 3,800 right now, and right now it's again consolidating. We're seeing it being in range. I've seen it go into 4,000 quite easily. Given the volume and given the amount of buying that's been happening, that could be a potential buy, potential sell here. From a medium term and potential drop to about that 37, 3,800. I mean, what do you think, Imre, on gold? Have you got any opinions on it so far?
Yeah, I mean, I shared on Twitter some of the fun I've been having with gold recently. Gold is definitely a great market to trade. I'm out now, so I have no position in gold. I'd love to be a buyer below 37.20 probably, but would have to wait to see exactly what's going to be, how this market's gonna evolve.
Mm,
Um, we're in This is common in commodity markets. You get a very emotional final wave, and this is what's happening in gold. This is going to be a blow off top type of situation. I have no idea where it's going to end,
yeah,
and I'm not trying to figure out where it's going to end. But so
yeah,
long as there's evidence that buyers are willing to accept higher and higher prices, I'm happy to be on the long side.
yeah. I mean, yeah, with gold, we had this massive range for over 2 years, right? We had this Russia war, which we thought, hey, with Russia attacking Ukraine, we are going to see insane moves on gold, but in fact, it just sold off, and it wasn't range for multiple months. And then out of nowhere, we had this. Essentially, what it is, it's a parabolic move up. And in my opinion, we've got over four catalysts to do that. Is the US losing its hegemony, dollar is weakening as a reserve currency due to tariffs, due to sanctions on multiple countries, due to war, and due to less stability from Fed. All of that is piling into the gold prices, and essentially where we are seeing right now, I'm not seeing too much retail buying just yet. A lot of it is institutional buying. If we look at Comex, as I mentioned, guys, if for anyone that's interested in commodities and specifically gold, Comex is the way to look at volume wise how much gold has been moved around, deposited into specific vaults, because that will be able to tell you who's buying gold at what volume and whether it will continue to do so. But yeah, right now, would you be a buyer? In my opinion, no. There's opportunity to buy here, but after that, yeah, I mean, why would you buy? From August, you really didn't have a chance. I mean, on the daily, you probably could. There was a little bit of that stability on that 3-2 mark, but yeah, ever since then, and maybe 3-6 mark if you were looking for a shorter term move, you had a $100 move up. But right now, I'm just yeah, I'd stay away from short term and long term buying or selling. To be fair, I mean, what do you think, in your opinion?
I'm short-term neutral on gold right now.
Yeah,
I'm seeing signs that buyers are getting tired. I've been looking at futures in the 38.10, 38.12 range. So waiting to see where we're going to rotate back towards. I would love to see us go back to like I see there on your CFD chart, it was 37.20. In the
yeah.
futures, it would be just below 37.50. So slight difference there, but I would love to see us rotate back there, and that's an area where I would be very curious to see how buyers will respond. Do I have any interest in shorting gold on the way down there? No, no, no. I don't. I'm not really a counter trend trader. If the trend in the market is obviously up, I'm going to be patient and wait for opportunities to buy the market, by and large.
Hmm.
I do have to jump, unfortunately, Matt. I'm
Yeah,
I'm
likewise.
late for another thing, but this has been so much fun. And apologies, it's totally my fault for the mix up with the link. I've never done, as a I'm terrible with technology. You'd be absolutely shocked.
Trust me, honestly, I was even mind boggled for 15 minutes. We were trying to work out
Yeah,
why
totally
we
my
having double
fault.
delays. So don't worry, we're both learning. This is our first proper stream, so hopefully everyone finds it educational, and as I say, educational and for entertainment purposes. So, but if you have any questions, both of us, you can check us both out on Twitter. MTradingX for me from researching point of view, and just market know-how and talking smack, and then from Imre from more of a professional institutional point of view. Imre SG, make sure to follow him. And then yeah, guys, if you've got any questions, you know where to find us. And it's been a pleasure, Imre. Looking forward to speak to you next
Yeah,
week.
cheers. Likewise. Always a pleasure.